So in this video, I will review the topic of finance and real estate. Subtopics include mortgage, deed of trust, and notes, financing and credit laws, and loan brokerages. So in the first topic of mortgages, deed of trust, and notes, we learn definitions such as what a mortgage is, what a deed of trust is, which is a standard security instrument using, this is like the real estate definition. Standard security instrument used in California real estate transactions since foreclosing judicially gives the borrower statutory right of redemption of up to 1 year in California. So there's a lot of terms we don't really understand in that definition, like what a standard security instrument is, or what judicially means, or statutory right of redemption, or even what a deed of trust is still. So in more simple terms, so a deed of trust is a standard legal agreement used in California real estate to secure a home loan. It's like a mortgage. It's another term for mortgage, except we'll get to that. It involves a neutral third party, a trustee, who holds the property's legal title as security for the lender until the borrower fully repays the loan. So a security instrument is the document that makes the property collateral for the loan, giving the lender the right to foreclose on the borrower's default loan terms. There are 3 parties in a deed of trust. There's a trustor, which is the borrower, the trustee, which is the holder of the deed, which is usually like an escrow company or title company, who holds the legal title of the house until the deed is paid off. And then there's a beneficiary, which is the lender. The foreclosure process, which is non-judicial, in accordance with the deed of trust in California, typically includes a power of sale clause, which allows the trustee to sell the property without court intervention if the borrower defaults. This process is generally faster and less expensive than a judicial foreclosure. So the right of redemption refers to the borrower's right to reclaim the foreclosed property by paying the full amount owed plus costs within a certain period of sale. Right of redemption. So a non-judicial foreclosure, the standard method for a deed of trust, generally does not provide the post-sale right of redemption. That's not included in a deed of trust usually. A judicial foreclosure, however, which goes through the court system, provides a right of redemption of up to 1 year. But this method is less common because it's much more lengthier of a process. 2 types of theory states. There's a lien theory state, which means the borrower or trustor holds the title, and the lender who holds the lien, claim against property but not legal ownership. The title theory state, which lender holds title, not borrower, and it holds title until the loan is paid off. So what's the difference between a mortgage and a deed of trust? So basically they're the same thing. The main difference is there's a couple. So mortgage involves only 2 parties, a borrower and a lender, and then deed of trust includes 3, which is the borrower, trustor, the trustee, the holder of the title, like an escrow company or title company, and then the lender, who's the trustee, trustor, and beneficiary. Foreclosure process. A deed of trust allows for a faster non-judicial foreclosure, whereas a mortgage typically requires a court process or judicial foreclosure of like 1 year, able to buy back your house and stuff. And then what is a note? So a note is a part of the loan stating who owes who, like all the transaction elements of a loan. Yeah, it's like the note. It's like the descriptive analysis of like a loan and everything like that. All right. Subtopic 2 refers to financing and credit laws. And so in financing and credit laws, we review vocabulary such as RESPA, which stands for the Real Estate, RESPA, Real Estate Settlement Procedure Act. So this is a federal law that governs real estate settlement practices, and the goals are to protect consumers from unnecessary fees and to ensure transparency in real estate transactions. Prohibits kickbacks between settlement service providers. So this RESPA is just to protect the home buyer, to protect the home buyer by requiring transparency in the mortgage and settlement process. Current RESPA disclosures include good faith estimate, which shows estimated closing costs for older loans replaced by loans estimate in 2015 from us loans. HUD1 settlement statement, which shows the final cost at closing for certain types of loans, and then the affiliate business arrangement (ABA) disclosure, which is if a lender refers you to a company they have an ownership interest in, they must disclose it. Basically, it's just to protect the home buyer in every way. There is the Truth in Lending Act, TILA, Truth in Lending Act. Which requires lenders to make disclosure that allows consumers to compare the cost of making a purchase using credit from different lenders and compares these with costs using cash. First, borrowers know exactly what they are paying for before signing a loan. Lenders must show goals of TILA or interest rates, finance charges, total amount, finance, number of payments, standardized comparisons, loan offers between lenders, meaning that, and then protect consumers from deceptive lending, which means it prevents hidden fees or misleading loan terms. So that was the reviewing of the financing. We went over deed of trust, sort of like a mortgage, basically, just 3 parties, lien theory, state theory. Lien theory, borrower has title, lender has lien, and then state theory is lender has title until it's paid off. Judicial foreclosure, that's in accordance with mortgage. Non-judicial foreclosure, that's in accordance with a deed of trust usually. And then a note, RESPA, Real Estate Settlement Procedures Act, protecting the home buyer, and then TILA, Truth in Lending Act. Truth in Lending, perfect. And then we went over, never mind. Lastly, we went over loan brokerage, in the topic of finance, which we more closely reviewed what an MLO endorsement is, which means mortgage loan originator endorsement. Basically explains an additional certification that allows a licensee to engage in mortgage loan activities such as taking loan applications, offering or negotiating loan terms, or presenting loan offers. So, like, you know how real estate goes hand in hand with loans, so you might as well get your MLO endorsement. It allows the licensee to act as a mortgage loan originator. They are legally allowed to originate loans, meaning they can take loan applications, advise borrowers of mortgage products, negotiate loan terms, and submit loans to lenders. So they originate them. They discuss that sort of stuff. And they are considered a loan originator under federal law because they help borrowers get mortgage financing. So yeah, that's all. Mortgage loan originator. It's just simple. They can just originate their own loan with this sort of license. It's a license that could be for realtors. It's an option in their career.